Welcome back. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com, and this is the Insight is Capital podcast. Today, we're thrilled to have a distinguished guest with us, Nicolas Piquard. Nick is not just any strategist, he is the Chief Options Strategist at Hamilton ETFs, where he plays a pivotal role in overseeing their expanding array of income-focused covered call ETFs. With a rich tapestry of over 25 years in the industry, Nick has carved a niche for himself, specializing in quantitative and options strategies. His expertise is further underscored by his tenure of over a decade as portfolio manager and options strategist with one of Canada's premier ETF providers. There he was the linchpin managing the day-to-day options activities of their covered call products. Beyond his professional achievements, Nick is also academically accomplished, holding a BA in mathematics from University of Waterloo and the esteemed Chartered Financial Analyst designation. Today, he joins us to delve into the intriguing world of monetizing volatility in both equity and bond markets. This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Welcome, Nick. It's awesome to have you on.
Yeah, thank you for having me, and glad to be back.
I'm really looking forward to catching up with you. Nick, before we get started, for those of us who may not be familiar with you and your work, tell us about the arc of your career, how you got into the options space, and what's going on, what's new at Hamilton ETFs.
Yeah, so a little bit about myself. I graduated with a math degree from Waterloo about 25 years ago. And, at the time, this was, in the late 90s, right at the time where derivatives were really starting to pick up as an asset class, becoming a lot more liquid. And there was a big demand for more quantitative skills. And that's kind of how I got my start in the business. I spent the first, 10 or 15 years on the sell side of the business, working as a liability trader, trading structured products, trading options with various Canadian banks. And then a little over 10 years ago, I made the move to being a portfolio manager and working on the buy side and helping, asset managers use options to use option strategies, and in most cases, generate extra yield for investors.
Thanks for sharing that, Nick. I wanted to, before we get into our conversation about volatility and monetizing volatility and covered calls, I'm curious to know with the recent flurry of bank earnings coming out of the money center banks in the U.S., how has the outlook in the lead up to that, because there was different expectations than what the actual results came out with. You guys are really big on you got a big focus on banks at Hamilton. What's your outlook there? What are your thoughts on the way forward for bank earnings? There was obviously much stronger interest income and maybe better than expected management on loan loss reserves. How do you guys see the path forward on the banks? And I'm asking you because banks are obviously a big deal for Canadian investors.
There's been a couple big trends on the financials, on the banks in particular. On the one hand, the rising interest rates mean that this is good for net interest margins. That can help. On the other hand, there's also going to be more in a weaker economy, especially in Canada, with the real estate market having more difficulty. That's going to lead to more loan loss reserves on that front. So there's a bit of pluses and minuses. I think on the short term, I would expect more volatility. I think it's really going to depend on when rates kind of top out and become a little bit more normalized. We've seen a flattening yield curve, which is not as good for the banks. But on the other hand, if you look at a valuation perspective, the banks are very inexpensive, trading at P ratios that we haven't seen in many, many years. So if you're looking at a more longer term view, I think it's a very compelling entry point for the Canadian banks. On the other hand, I would expect more volatility. Usually when we look at, fourth quarter earnings that will be coming in the next, in Canada in the next couple months, that's usually when you try to clean up everything and set the new year. So I think right now we got to look ahead of the new year and see how things evolve. But overall, with these rising rates, the financials have gotten, punished a little bit. And so that creates, potential buy opportunities.
Would you say that relative to the U.S., Canadian banks would maybe experience a little more chop because of the shorter mortgage terms, for example, and different lending standards?
Yeah, I mean, I think traditionally, I think Canadian banks have performed better. Have had less volatility than in the U.S. The rules for mortgages and whatnot are a little bit more favorable to the banks than in Canada than they would be south of the border. And there's a lot of competition in the U.S. as well in terms of how their banking sector is structured. Whereas in Canada we have more big six banks, and they have tools to increase profitability. They're very focused on cost cutting, and I think we can still expect some volatility. We're seeing some volatility today, and this is good for what I do in terms of the cover cost strategies. But overall, you look at some of these P ratios on some of these banks, and they're going back to lows that we haven't seen in many, many years.
Yeah, so they're quite attractive. They've got strong dividends, and you couple that with the call writing, it makes for a very attractive scenario.
Yeah, exactly. Yeah. And I think that we haven't seen a scenario like that on the cover call side in many, many years, in a sense that we're seeing a bit of a bottom evaluation, and so hopefully a bit of a support in terms of overall prices. On the other hand, there are some overheads that we're going to have to deal with, and that's going to be kind of a volatile process. And that kind of an environment is very conducive for covered calls, because we're giving away some of the upside, and hopefully that's not too much of the upside given the environment that we're in. But we're also getting a lot of extra yield from the call options that we're selling, because the volatility environment is higher than it's been historically.
I was just in whenever I go to travel to the U.S., I always notice, the number of Canadian banks that have ownership of U.S. banks, and the number of stadiums that have naming rights that are Canadian banks, BMO, TD. You got several BMO fields. You got TD Garden in Boston. You got a bunch. You see all these. It's very proudly. It must be. It's a source of great pride, I think, when Canadians travel. But does that diversification of Canadian banks, Canadian bank ownership of U.S. regionals and larger, and some of maybe even pieces of some of the larger U.S. banks, does that also improve the general outlook for the Canadian banking sector?
Yeah, I mean, I think there's certainly very, very good deals to be had right now. The regional banks, as we know, with the crisis, really got punished, and some were forced to go bankrupt. Some of them were acquired. But they're definitely, in terms of valuation, they're very cheap. The problem, of course, is that they're going to need access to capital. They're going to need to get through some of the rough spots, and this is where the Canadian banks can take advantage of that. They have they're well capitalized. They have the opportunity to look at these look at these regional banks and potentially get a good deal. You look at JP Morgan with their acquisition. they, just on their earnings today, they recognize a big gain because they have the capital required. They can buy the assets at a good level and take advantage of that.
So I had to ask you about the banks because, about the financial sector, at least, because during the last month, there has been a lot of chop in the market. There has been a rise in volatility. But in the midst of that, the financial sector did quite well. Conversely, contrary to that, of course, some of the mega caps had a pretty rough month, and the S&P 500 experienced a fair bit of volatility. How are some of the recent sharp declines and increase in volatility in equities in general creating potential opportunities for you and for covered call option writers in general?
So, like I was alluding to earlier, a higher volatility environment does help a covered call strategy. And why is that? Well, basically, the price of the call option that we're selling increases in a higher volatility environment. And so the higher volatility that we're seeing in the market, the more of a premium we're going to get for the call options that we sell. In addition, because the price is, moving around more, we can look for good levels and good strike levels where we can sell the calls so that we're still getting a good cushion on the overall, performance of the fund. So, that doesn't always work out perfectly. There could be situations where, you're selling a call option and it turns out that that's potentially the low on the stock in the short term. And then, the stock might recover from there. But what we try to do is we try to diversify and use a strategy which, we use certain different price points when we sell our call options. And this allows us to really take advantage of the volatility overall and not just pick one day where we're going to sell our call option. So there could be cases where, a short-term low might be a bad time to sell a call option because you're selling,
Right.
too much of the upside. And so you don't want to be necessarily doing your whole position on that at that time. You might want to wait for the stock to recover and sell the call option then. And what's interesting and what's good about a volatile environment that we're in right now is that you're going to get short-term lows, you're going to get short-term highs. You're just going to get a lot of volatility, and it's
Right.
going to trade within a range. So as long as you focus on the higher end of the range, you're going to be able to perform better.
So does that mean you would go, but does that mean, if I understand it properly, does that mean you'd go further out on the option chain? Or
Yeah, so like the basic, not necessarily further out. You could do that. You could use maybe a slightly higher a strike, but more importantly, you would look at selling the option when you're at the higher end of a price range. So maybe if you're looking at a short-term chart and you're looking at an RSI or something which shows you overbought and oversold. In a volatile environment, this is where stocks tend to trend less and be a little bit more range bound in a sense, but within a bigger band, within a more volatile
Right.
band. So something like a Bollinger Band where you're going to see a widening of those upper and lower bounds. And if you can use a covered call strategy that's getting a good amount of premium, but also taking advantage of the fact that stocks are going to move around, they're going to be more volatile than normal. Take advantage of that volatility.
you mentioned the short-term low, the concept of the short-term low, and also, of course, conversely, the short-term highs. But the short-term low as being something that you'd want to avoid getting in on because then you might get called, you might call away a lot of your upside if the market whipsaws from that short-term low. And we've recently seen, very recently seen examples of short-term lows in SPX and TLT, proxy for the long duration U.S. Treasury. How how would you navigate that? Like how can you use that to your advantage, or how do you navigate? I think I don't know if you already covered this, Nick. If you have, then we'll just move on. But how do you navigate that situation where the market has potentially more downside? Like if the market has more downside from the current lows that we're seeing, that's beneficial, I take it.
Well, it would work well in
to
terms
your
of capturing
strategy.
extra yield.
Yeah.
Of course, it doesn't work well for the
Right.
overall, portfolio, but in the short term, that would actually be beneficial. But we actually
Right.
get that question a lot, Pierre, and one of the examples I like to give is what happened in March with the financial crisis that happened in the U.S. with the regional banks.
Right.
That was a very precipitous drop.
We spoke then.
Yeah, right. And that was a very
We spoke that, yeah.
exactly, and
That was a phenomenal time, yeah. So,
and that was a very precipitous drop in
Yeah.
the regional banks, and it dragged down the Canadian banks along with it. But for the Canadian banks, which were less impacted overall, then they mostly recovered in the following month. And so, how do you navigate that as a covered call writer? And that's a little bit difficult because on the one hand, you're getting that extra volatility, but on the other hand, you don't want to give away too much upside. And there's a couple ways that you can manage a situation like that. The first thing is you can take advantage of the higher volatility level. So in the case of the banks, for example, in our fund, HMAX, we generally try to write about 50% of the fund because we're really focused on generating extra income. But in a very volatile environment, you don't need to write 50% of the fund to get the same amount of premium. And so in the case of in March, with the regional banks having sold off, we actually only needed to write 35% of the fund because the volatility levels were so much higher. So that's one way that you can kind of help navigate that, is you can write a little bit less because the premium is already high enough. You don't really need to write quite as much in terms of the call premiums. And so that helps navigate any kind of recovery. But the other way that you can kind of help mitigate some of the risk is by not writing everything at one point in time. And so if you're waiting over a few days or a couple of weeks and you're waiting for better entry points in terms of your covered call strategy and things recover, you're going to get progressively higher and higher strikes on the calls that you're writing.
Right. So you have the option you have the ability to either pick a strike price appropriately.
Correct.
Or to pick the expiry of the option, the expiration date of the option appropriately. That's another way of diversifying your exposure.
Absolutely.
Right. And then you also have the option of writing or not writing.
Exactly.
So for example, like you could close out your options if you think you have too much exposure at a short-term low. You could increase your option writing when you're closing in on a short-term high, right? So you have all these levers that you can pull throughout the process, right?
And absolutely. And this is why an active call strategy can really help versus using a more passive approach. Because when you're tied to a passive option strategy, you have, and say you're following an index, for example, you have to sell at a certain point because that's what the index tells you. And you really can't, even if it might just be common sense, I can buy back, it's a volatile environment. I can buy back these way out of the money calls and it's only going to cost me a nickel. In an index passive strategy, you're not really supposed to do that. You're really supposed to follow a passive strategy. So an active strategy can help you in situations like that. And furthermore, just like you said, for example, if we think things are going to be very range bound, but only for a few weeks ahead of earnings, for example, and then after earnings, things might move a big way, one way or another, we might just pick the expiry accordingly. Let's pick options that expire before the earnings, wait and see what happens with the earnings, and then kind of resume the strategy. So there, options are complicated, as you said. You can use different strikes. You can use different expiries. You can time things a little bit differently. So there's certainly a lot of levers that you can pull.
I think you're making a really strong case for why you wouldn't want to try to do this yourself. And you know, it could, because it is complicated. There's so many moving parts and so many choices, so many levers that can be pulled. It does require, you know, full-time devotion to it. I think it's interesting, you know, like in just doing, you know, even background research on the internet about, you know, buy right strategies, which is one of the common ways these are referred, like at least the passive strategies are referred to as buy right. You know, I just want to highlight the fact that it's very important to delineate between, you know, actively choosing to write, you know, a third or half of the portfolio versus passively buying something that writes 100%. And, you know, when you go reading on the internet about covered calls and buy right strategies, what you find it invariably is the opinion that, oh, you know, if the market's in an upside bias, these strategies, you know, they rob you of your alpha, right? And why would you do that? And so, you know, people have I think a lot of advisors, a lot of investors have the impression that, you know, these strategies are not long-term strategies. These are tactical. But that's not true. That's just simply not true. If you managed the, you know, the percentage of writing and you know, the other levers properly, this is actually a strategy that, you know, you guys have proven has very long-term hold merits.
Yeah, and you have to think about, you know, why you're buying a covered call strategy. Most of our supporters, most of the buyers of our funds, what they're looking for is, you know, tax efficient income, and you know, on a portfolio which they like and which they think is a good asset class. You know, Canadian banks or Canadian utilities, names that they think are safe. Or as we'll mention later as well, we have a new covered call strategy on treasury bonds, which also consider very like a very safe asset class. And so, taking an asset class that you like, that you think is safe and generating, you know, tax efficient income, and you know, amongst our biggest supporters are investors who have done covered call themselves, are very good at doing covered calls, but it takes a lot of time, a lot of effort. You have to monitor the expiries. You have to, you know, roll the options. You have to decide when to write, when not to write. All the things that we've been talking about today, and that takes a lot of time. And so, why not get somebody else to do that for you?
Absolutely. Coming back to the strategy, is it safe to say that? Correct me if I'm wrong, but is it safe to say that the lion's share of activity in what you do tends to revolve, you know, in today's large and longer duration stocks? I mean, I'm saying large stocks because they're the most liquid and they have the most option liquidity. I want to get to the question about longer duration bonds or exposure to longer duration bonds as part of a you know, volatility monetizing strategy such as covered call writing. But let's just talk initially right now about longer duration stocks, like some of the big highly liquid tech names that are dominating the market right now. How much of your activity is surrounding that, you know, the large tech long duration names that have enjoyed, you know, huge upside? Are you looking at that as a sort of, you know, large opportunity going forward because of the valuations?
Yeah, I mean, absolutely, and you know, we are looking at launching some funds which will be focused on, you know, the large cap tech names, and using the same covered call strategy that we use for the banks and the utilities, and applying that to the, you know, the large cap tech, large cap US names. The great thing about
I can see where you know, going forward, a lot of investors will start to look at insurance against those stocks, you know, protecting their downside, and that's where, you know, you could come in and write part of that portfolio or part of those holdings, you know, to those seekers of insurance. right? But the premiums will probably be very, juicy.
Absolutely, that's a very good point. You look at the options on, some of the, the big five, large cap names, Microsoft or Apple. These names are names that perform very well still. Arguably they're not even though they've done very, very well, they're very profitable companies, and they make a lot of money. And so,
but they're also inherently volatile, right?
Absolutely, because they're, despite that, they're still tech names, they're still technology names, and they still have a large amount of volatility. And so when you look at the amount of extra yield that you can generate on a covered call strategy in those types of names, what's great about that is that you don't really need to write quite as much in terms of the overall portfolio. You can reduce your coverage to 25, 30%, which allows, the investor to still get a significant amount of upside. One of the trade-offs, of course, with a covered call strategy is that you are giving away some of the upside by selling, the call options. And so on a utility basket, maybe you're not so concerned about that because you don't think the utilities are really necessarily a growth type asset class. But when you're looking at, a tech sector or even a sector, like energy where you can go on big trends, upside matters more. Now, the upside, of course, is that you're getting much more yield, much higher premiums for the call options that you're selling, and therefore you don't really need to write as much. And that gives, that can give the investor confidence that, okay, I'm still getting a relatively good yield, and in addition, I'm getting more of the upside on a basket that can be certainly more volatile. But further to your point on those large cap names, we've seen a big divergence in the performance of large cap tech such as Apple versus the utility sector or the financial sector, which seems to have really gotten a lot more punished in this higher rate environment. And so perhaps this is the time where a covered call strategy might work well in that sector, in the sense that the stocks are high already. But there is kind of an increased volatility environment. So if you still like it long term, this is a way to maybe reduce some of the volatility, get a little bit of extra yield.
It strikes me as contrarian at heart. I mean, what I like the sound of, like, for example, like, in the banking sector, I mean, Canadians have been in love with bank stock ownership, forever. So, given that there's a strong likelihood that Canadian investors will want to continue to own or have a stake in Canadian banks, the contrarian aspect of having something in your stable of fund, on your roster of funds in the portfolio seems like makes for great diversification.
Well,
would you agree with that? I mean, does that help to sort of allay some of the short-term, downsides that can occur at times, and volatility that happens? I mean, especially in the period ahead where, things could get a little bit dicier with interest rates and with the economy slowing down, and maybe more problems coming to the surface overall in the financial sector as pressure mounts against consumers and borrowers. Do you see that as potentially like an opportunity for investors to sort of diversify away some of their risk in favor of the protection that the covered calls offer, because you're monetizing volatility? So if we're heading into a period of a dicier period, more uncertainty, there's a counter trend there, right? And so what I'm getting at is if you have an opportunity to exploit the counter trend, that's something that you're strongly in a position to do with a call writing strategy.
I think that's a very good point. And I think, the volatility environment that we're in now is, I think on average, going to be, a much higher volatility environment than we've seen, in the past 10 years. And so having, further to your point, having some assets in your portfolio that can, take advantage of that volatility, I think that makes a lot of sense. The way we position our covered call products for investors is really investors who are looking to monetize the volatility in order to get extra income for their portfolio. As you mentioned, Canadian investors love banks. A lot of them own the banks. They're happy, getting their dividends, and they're not too concerned about whether they go up a little bit or go down a little bit. They're happy to own these stocks for the income, and this is what the covered call strategy does. You are giving a little bit of upside, but you're monetizing that volatility and you're getting that dividend income. So, with a lot of, advisors whose clients are, getting older, and we have an aging demographics globally and in this country as well, they're going to need to generate more income. And if that can come in a kind of a tax efficient way, because we haven't mentioned this, but the call premiums that we're getting on the call options that we sell, those are taxed as capital gains. So, for an investor, that might be advantageous in terms of the income they collect on that.
Yeah.
And dividends. So dividends and capital gains, more beneficial than just receiving regular income. But at the end of the day, investors don't necessarily want to rework their entire portfolio and sell all their banks and so this is a way to kind of, readjust, your portfolio. You can reallocate some of your financials exposure to a product that does covered calls, raise the overall yield on your overall portfolio, and monetize some of the volatility, as you said.
Yeah, the tax loss selling angle on this is pretty.
That's a good point. We're looking at I'm sure there's a few investors.
Well, as we're coming into the year end here, right? There's really a nice opportunity, as you said, to diversify laterally from like either direct ownership or fund ownership of the banking sector to what you do at Hamilton in the banking sector, where you can capture the tax loss, make the lateral stay in the sector, stay in the banking area, in the banking sector, and continue to own it, but now enhance the overall yield that you get. You're not simply just getting the dividends anymore. You're going to get the dividends and the upside from the tax efficient income from the
and of course you're not going to get the full upside on the banks. But if you think things are going to be kind of in a trend or in a range, and you're still getting half the portfolio is still going to be uncovered, so you're still going to get some. You're still going to benefit from.
But what's the big question there is, what's the overall trade-off? What am I getting for that decision? And if the answer is more income, the same ownership, why? Yeah, it makes a lot of sense, especially if you're looking for more income from your existing holdings. Now, you guys have. I want to talk about the bond market, because you guys have recently launched a new strategy, a new ETF that exploits the volatility and the yield in the bond market. And I guess my first sort of big question is, why hasn't anybody done this before?
You're not the first person to ask that question. When we launched HBND, which is the first covered call bond ETF, a lot of the questions that we're getting from investors was like, "This is a great idea. How come nobody's done this before?" And I think there's a couple reasons, for that. The first reason is just kind of a practical, fact of life, which is, bond ETFs are kind of a more recent development in the ETF world versus equity ETFs. TLT, which is the ETF that we use for our covered call strategy, it launched in 2005, I believe, but it really started to gather steam, over the last 10 years. And so before that, there wasn't really that much, liquidity, and certainly not enough options liquidity to do kind of a cover call strategy. Now you look at,
But it is the most important proxy for long-term bonds in the U.S.
and you
Treasury
look at
market.
the assets of TLT, just even in the past 2 years, they've almost tripled, and it's now one of the largest, bond ETF. It's amazing. It's one of the biggest bond ETFs, in the U.S. and the world, I believe. So we're taking this ETF, and because it's such a big ETF and it's so liquid, it now has very liquid options market as well, and we can use that for the cover call strategy. So that's the first reason why it hasn't really started. It really didn't get traction until recently, and even in the U.S. where the ETF,
as you said, it started in 2005, but it really gathered steam as rates were falling, and commentators started using TLT almost exclusively as a shorthand for long duration bonds, so that you didn't have to always say, "Oh, what's happening in long duration bonds?" People just started saying, "What's happening
absolutely.
with TLT?"
I think you're right.
And
I think
everybody knows what that means.
TLT becoming, one of the, the largest, bond ETFs, and as you say, a proxy for the long-term yields. I think people quoted that long duration yields much less. I think people more focused on the 10-year and on maybe the 2-year. They didn't really, TLT has really kind of opened up, that to all the market observers. It's become kind of a proxy, as you said, for the long-term yields. And one of the I think is the other reason why covered calls didn't really become a very compelling opportunity until recently, is of course until recently bonds just went up. And
that's right.
Yeah.
And why would you do that? Why would you launch a covered call ETF in a rising in a market where rates are going to zero?
Since 1980, bonds have just gone up.
Or staying there,
and furthermore, of course, since the global financial crisis and until the pandemic, the Federal Reserve was actually buying long-term bonds and doing QE. And so not only did that help TLT do very well, but it also reduced the volatility. And so in some sense, the fact that the Fed was always in there, bidding bonds and increasing their balance sheet, that kind of reduced, volatility levels a little bit. And so both those things, the fact that bonds were just going up and the fact that volatility wasn't super, super attractive, meant that bond covered call strategy really didn't make sense. And, it was kind of hard to do anyway because, TLT was growing, but the options market was just picking up. And so now we have a kind of a perfect environment where, bond yields are back to levels which we haven't seen basically in a generation on the long bond. And we have higher volatility levels. We have liquid options market. We have very liquid ETF, and so this is almost, it was almost crying out to be done as a covered call strategy.
Yeah. So now you're obviously, Nick, you're following the long duration market very closely, as it's sort of the crux of what you're doing with HBND, H bond. What would you say, just if you can comment on what's been happening most recently, like where is all the pressure coming from aside from the obvious, which is the Fed's stance on short-term rates, being higher for longer. And as you said, you mentioned previously the yield curve flattening some. Where is the pressure coming from in regards to the TLT, the long duration bond yields rising in the last couple of months, the way they have, and hitting these, these near term or even long term, lows that we're seeing. Like, I mean, the bond market, I mean, long term treasuries have just gotten hammered, right? I mean, so now, the potential upside around the corner as monetary policy starts to recede a little bit or soften, become more dovish. What is it exactly? Because I think, there's a discussion going on around things like term premium, putting pressure on that. And I don't want to steal the lead. I want you to, answer
No,
the
absolutely.
question.
And, I think there's there are several big factors at play here. And when we talk to investors, there are a lot of investors who are like, oh, we're back to, where we were in the 70s and 80s. Yields are going to go, even higher. And why would I even want to, own anything on the long end? And then we have also investors who are saying, this is amazing. I mean, I never thought I would ever be able to get this kind of yield on the long bond, and now I'm able to lock it in.
Right.
Only 3 years ago, I thought I would never be able to get that kind of income with that kind of safety. So and I think that's what makes the market. And I think what's really driving the long-term yields is, of course, this realization that inflation is going to be a little bit more difficult to pin down. And I think there's a few reasons for inflation remaining sticky in some sense. You're going to see, you got a demographic wave that's coming where you're going to have a smaller working population, a bigger aging demographic, aging cohort, which means the demand for labor is going to be pretty good, I would think, over the next little while, given that we're going to have a shortage. Yeah, and you hear about it in a lot of different sectors, certainly in nursing and healthcare. You hear it in a lot of different areas where people are having a hard time finding people, and that's going to be inflationary on wages. The second aspect is you have deglobalization, which, supply chains. People talk about supply chains. This really a function of deglobalization. The fact that we can't be reliant on China to make everything for us anymore. We have to start getting other countries to do the same thing. We have to start doing stuff more for ourselves, and that's also inflationary because it costs money. You gotta invest in new infrastructure. You got to do a whole bunch of new investments and whatnot. And the final thing is, we talked about Fed, raising short-term interest rates, but they're also reducing their balance sheet, and they have a very, very big balance sheet. They're not really that close to being done, and that's more supply of long bonds, given that the federal government is not really cutting their deficits. They're still going to be issuing more debt, and so all those things are going to keep rates high. Now, what's the counter argument? Well, the counter argument, of course, is you look at global debt to GDP. You look at how much debt is both government and especially in Canada, household debt. It's also there's only so much that the economy will be able to handle in terms of higher rates over a long period of time without causing some significant issues. And so I think that you have a very good case for rates staying pretty high, but also a very good case for rates coming down. And I think that's going to lead to a few things: a very volatile environment for the long bond, and you see it today. Actually, maybe I'm going to. This is a good time to share my screen.
Hey, yeah, please. And I'm curious also, while we're on the subject of pressure on yields, I mean, China also is a factor here as well, because they're not buying treasuries the way they used to. I mean, if anything, they've been selling them.
That's a very good point.
Right? That's another pressure
and
point
the
for
Japanese,
yields. Yeah.
aren't either. A lot of the buyers, traditional buyers of
Right.
U.S. Treasuries, had been the big saving countries such as China and Japan, and because hedging, especially in Japan, because the hedging the currency risk on those U.S. Treasuries for them is become so expensive because short-term rates are so high. They're basically being priced out
Right.
of the U.S. Treasury market, and so it's actually more attractive for them to buy their own Japanese bonds, which are also going up in yield, although not nearly as significantly. But if I,
And would you say on a turnaround, like if we do actually at some point next year enter a period where rates are being cut, for example, like if things get to the point where the Fed has to take their foot off the brake, would those historical buyers like China and Japan, when
I think
the
so.
market
I think
suits
so.
them,
I
would
think
they come back into they would come
I mean,
back
I'm
to a
not
market
sure.
where yields
I'm
were
not
falling?
100% sure about China because,
In
of
order
course,
to-
there's a geopolitical aspect to China in terms of,
Yeah.
uh, yeah. But
Yeah,
certainly,
exactly.
I think
The
in
wild card
Japan,
there,
if
yeah.
you see short-term rates coming down, and all of a sudden it makes a lot more sense for them to own U.S. Hedged, long bonds. I think that they'll return to the market, and because the U.S. long bond yields are significantly higher than what you can get on Japanese bonds. I think this is one of my most interesting charts that I've seen recently, and this is a chart. It's all about volatility, which is my wheelhouse, and it's really showing the movements in interest rate volatility as measured by the MOVE index, and in red,
Right.
and
In red.
comparing it to S&P volatility in gray, and that's measured by the VIX, which most people are aware of. Now, a lot of people look at the VIX. The VIX is a measure of equity volatility, but there are fewer market participants that really look at the MOVE index, which is a way to measure interest rate volatility. And what's fascinating to me about this chart is how both really move in lockstep, and until kind of recently, and in the past kind of year and
Right,
a half,
yeah.
when the Fed kind of returned to raising interest rates, the interest rate volatility has remained extremely high, even though the VIX has come down. And I don't think that that's necessarily sustainable. I think that, there's a case to be made that the VIX is too low relative to interest rate volatility. Because I don't like we were talking earlier, with all the things that are happening in the world today, I don't see interest rate volatility going down very much. Not at a time where the Fed is trying to reduce the size of their balance sheet. I think that's going to create more interest rate volatility, not less. And so I think there's a case to be made that we're going to see higher VIX levels, and I think it really shows. Well, what this chart really shows is over the past, since between 2011, 2012, and kind of 2019. Volatility was abnormally low, both in interest rates and in equities. And I think that now we're, and I think that's really it's a function of financial conditions and how easy or tight they are. I think that the financial conditions were incredibly accommodative, in that 10-year period. And now they're not even that, I don't think they're even that tight. They're kind of coming back to normal, to what we kind of knew previous to the global financial crisis. And so that's leading to this higher volatility level. I think interest rate volatility is leading the way here in terms of telling the market, be ready for more volatility. And I think that, other asset classes, and you're seeing it
Right.
in the interest rate sensitive asset classes. You're seeing it, like we were talking earlier, you're seeing it in financials, you're seeing it in utilities, you're seeing it in any kind of asset that has very long, duration, in terms of, a lot of the growth stocks, maybe not stocks like Apple because they have so much cash and they're almost like cash cow tech. But certainly in the more speculative tech names, you've seen way more volatility.
Yeah, that's absolutely remarkable. Like what a chart. Like it's kind of ominous, right? It's the divergence between VIX and MOVE is pretty
well, it is. I mean, the MOVE index
threatening,
is higher today than it was in the beginning of the pandemic, which is pretty remarkable. But this is all good news for a covered call strategy on bonds, which is H bond.
Yeah. So let's talk about that. Let's talk about H bond, about the H bond strategy, which you recently launched. Launched. How does it work?
We developed this ETF such that we wanted an ETF for investors that could get extra yield from the fixed income market. And up until now, investors really just could reach for extra yield using a covered call strategy. They had to, use equities as an asset class. But more and more people need a higher allocation to fixed income as they get older. And so we thought that fit really well within that context of, investors need for more fixed income exposure, but they also need more yield. And so this is where H bond makes a lot of sense. And the way the product is structured is that we try to own a lot of the different durations on the U.S. Treasury curve. So we have an allocation to short term, we have an allocation to medium term,
right.
We have the allocation to long term, and then we have a big allocation, which is half the fund in TLT, and that's what we use to do the covered call strategy. So half the fund is basically TLT, and we're riding on that half of the fund. And then the other half of the fund is a mix of different ETFs with a variety of durations. So I would say that overall, certainly H bond has a lower duration than if you were just own TLT, because not only are you doing a covered call strategy, but you also have a mix of various durations on the underlying funds. But on the other hand, it's less risky. It's going to have less volatility in terms of owning this versus just owning TLT. But of course, so this is not a fund that you want to own if you think yields are going back to 1%. You're really, if you really think that, then you should really just buy, kind of a TLT. But if you're looking for, a fixed income allocation, which can yield tax efficient income and has a higher yield, and right now we're kind of targeting a 10% plus yield on that ETF. This fits well because, if you think about the fixed income market and what you need to do to get extra yield, well, you have to go to private, maybe some mortgages or some kind of more credit based kind of strategies. You really have to, move out of the credit curve. And what we wanted to do is like, okay, no, we don't want you to take any more credit risk. There's basically zero credit risk with the U.S. Treasuries, although some people might argue, that that's not 100% true, but it's certainly one of the least risky in terms of credit. And furthermore, you're getting the tax efficient covered call premium. So you're getting you're going to get your 4%, 5% of income, and then you're going to get the some covered call premium in addition to that. And so we, in this environment, actually, because the volatility levels are so high, we don't really need to write. We have the ability to write up to 50%, but we don't have to write the whole amount right now. Right now, we only need to write maybe 35% to get very attractive yields.
So, and given the year that it's been in the bond market, and the year that it's been for long duration bonds in particular, obviously we know what's happened at the short end, and that's sort of the easy money. but in terms of where investors are in the longer duration part of their bond allocations, this again, like what we were talking about earlier, seems like an interesting tax loss selling, tax loss harvesting opportunity where you can make a lateral move from the traditional bonds or traditional bond ETFs into the covered call strategy that we're talking about, into H bond to once again exploit the long-term yield opportunity at the longer end of the yield curve, but also more importantly, the covered call yield that you're going to be able to garner from this higher volatility trend that we're in, possibly for a long time, with the Fed with its foot on and off the brake over the next couple of years.
I think that I mean, a lot of people try to compare the environment that we're in with various points in the history. Whether it be a post World War II an environment that way, or maybe an environment like we had in the in the 1970s. And there are similarities. Like we see there were both cases where there were big conflicts, and we're starting to see that today. I think we have kind of a need for government spending in a lot of different places. We have a need for government spending in terms of the conflicts, the supply chain issues, the fact that we're deglobalization happening. But furthermore, we need huge amounts of investments in terms of the climate change, which is kind of another kind of conflict that we're facing, and that's affecting kind of everyone. So you have those kind of similarities. But then we have big differences. The demographic change is not something that we really faced before. And so, there might be some, there are some similarities, but there's going to be some differences. And I don't know what the exact right answer is going to be. I wish I knew.
You don't have to have the exact right answer. You just have to be slightly, you just have to be slightly better than 50%. And even that's a reach. You probably don't even have to be that correct. I mean, a lot of investors have been extremely successful, just shy of 50%.
If you can get just a little bit over 50% batting average, you're already doing very well. Yeah, exactly.
Yeah. I think what's really interesting here is that, at least in my experience, I don't know if I speak for how advisors think in general, but, I feel like in the past, a lot of decisions that were made in portfolios were binary. But now there's really this incredible opportunity, I think, because of the sort of the innovation of a lot of, indexing and, using proxies, and in your case, using TLT as a way to monetize volatility, as a way to monetize volatility from, that now that it's possible and it's timely from TLT. There's a real opportunity for investors to fine tune their portfolios, and it doesn't necessarily mean having to go, to some of the more esoteric or private or less liquid forms to do that. In both cases, like in sort of equity representation, you have the opportunity to take advantage of the trend in volatility in equities. But now, looking at that yield. Looking at the the move to VIX spread, it's exciting. That's actually a pretty exciting look at what's in store for bond market volatility if you know how to monetize it. And that's your wheelhouse.
I'm very excited about this.
But I think that
it's, I imagine not only is it there are only very few covered call ETFs out there. You compare that to, we were the first, but there's a few more now. But you compare that to the equity covered call asset class. That's become a very, very large asset class with a lot of different ways to approach covered call writing. And I think the bond is going to develop into bond covered calls is also going to develop into a big asset class. I think the opportunity is too big to ignore, and so I'm very excited. I think it's going to be a very popular and very timely opportunity.
I really fancy the idea of being able to adjust the trim on a portfolio. You know, I think, you know, for boating enthusiasts, that's maybe a good analogy, but when you can do that kind of fine tuning without having to make, you know, I think there's an avenue there for investors that doesn't require a major adjustment of attitude. It's really, you know, it's a lot more nuanced. It's it's like turning the trim knob on your engine and getting more output.
Yeah, and I think
same
you know,
exact
further to your
motor.
point, it's like, you know, turning the dial a little bit.
Yeah.
You know, you don't need to turn the dial on or off. You can just you just turn the dial a little bit. Yeah, it's not a binary thing.
It's not binary. It's not an on-off. It's not a 1 and a 0. It's not an on-off switch. It's literally just, you know, 1.1, 1.2. Just, you know, increasing the volume and the bass and the, you know, you got so many great analogies that we can use here to, you know, sort of get to the bottom, you know, of the story. But
yeah,
Nick,
no, absolutely.
where can
you know,
people
the best
find
way
you?
to get in touch with me is through our website. You know, we have a lot of resources there at HamiltonETFs.com. I have videos explaining cover calls.
Right.
We have explainer videos on all our ETFs, whether it's financials with HMAX and utilities with UMAX, or with our brand new bond cover calls, which I'm very excited about. With H1, we have videos on all those. Yeah, so please come to our website.
Nick, thank you so much for your incredibly valuable time.
Look forward to speaking with you again.